December 19th, 2025 is not just another ordinary date on the perpetual calendar of any investor. It is a moment destined to trigger a financial earthquake capable of rewriting the entire global economic order. While the vast majority of America remains fixated on stock indices that appear healthy on the surface but are rotting underneath, or distracted by the political circus in Washington, a perfect storm is silently forming in East Asia. It is here that America's two largest creditors, Japan and China, are forming a pincer movement that is tightening its grip around the US dollar. This is not some far-fetched hypothesis of collapse, but a brutal economic calculation playing out in real time, as Japan, America's most loyal financial ally for the past 50 years, is forced to pull the plug on the US economy's life support simply to save itself. Before we perform a forensic autopsy on what may be the most significant financial event of this century, take a second to hit subscribe and turn on notifications, because the information you are about to hear will never appear on mainstream financial news until it is far too late. To understand why the roof of the American economy is about to cave in, we cannot simply look at the Federal Reserve. We must look at its foundation, a foundation that was surprisingly poured in Tokyo. For over half a century, Japan has played the role of a silent yet critically important partner, holding over $1.18 trillion in US Treasury bonds. This makes them the largest foreign holder of American debt, surpassing both China and the United Kingdom. But what makes Japan truly dangerous to the dollar system is not just the massive amount of debt they hold, but a complex financial mechanism that has operated seamlessly for 2 decades, known as the yen carry trade. At its core, the yen carry trade is a massive money-printing machine that has pumped blood into US financial markets for years, operating on the principle of extreme interest rate differentials between the two economies. Imagine walking into a bank in Tokyo and borrowing billions of yen at essentially 0% interest, a free money rate that has existed in Japan for 20 years to combat deflation. You then take that borrowed money, convert it into US dollars, and invest it in higher-yielding American assets like government bonds, tech stocks, or real estate, earning returns of 4%, 5%, or even 10% annually. This is exactly what hedge funds, investment banks, and even individual investors have been doing relentlessly, creating a massive flow of capital estimated to be in the trillions of dollars flowing from Japan back into the US. This arrangement became the secret engine of American prosperity. It kept mortgage rates low for American homeowners, inflated the stock market bubble, and allowed the US government to run massive budget deficits without immediate consequences. Essentially, Japan wasn't just buying America's debt. They were subsidizing the American way of life by exporting their cheap capital, keeping the yen weak to support their exports, and keeping the dollar strong to maintain the purchasing power of the American consumer. However, that era of cheap money officially ended on December 1st, 2025, when Bank of Japan, BOJ Governor Kazuo Ueda, stood before business leaders in Nagoya and delivered a statement that sent shockwaves through global markets. He announced that the BOJ would seriously consider the pros and cons of raising the policy interest rate at their upcoming meeting on December 18th and 19th. This declaration immediately triggered panic, jumping the probability of a rate hike from 58% to 76% overnight, sending Japanese government bond yields to their highest level since 2008. And causing the yen to strengthen dramatically against the dollar. Why would a small shift in Japan's interest rates from 0.5% to a projected 0.75% cause a chain reaction collapse for the US economy? The answer lies in leverage and the sheer scale of the yen carry trade positions that are now being reversed. As Japanese rates rise and the yen strengthens, the profit margins of these carry trades are wiped out, forcing investors to execute an unwinding of their positions. To repay the yen they borrowed, they are forced to sell the dollar-denominated assets they hold, including Apple stock, Nvidia shares, and US Treasuries, to convert the proceeds back into yen. This process creates horrific selling pressure on US assets and generates a death spiral. The more investors sell US assets to buy back yen, the stronger the yen becomes. And the stronger the yen becomes, the more other investors are forced to cut their losses and sell assets, creating an unstoppable domino effect. We saw a trailer for this horror movie in August 2024 when the BOJ executed a surprise rate hike. In less than a month, the Nasdaq 100 fell 13%. The yen surged 14% against the dollar, and global markets went into freefall. Yet, that was merely a minor tremor compared to the true earthquake awaiting us in December 2025 and beyond, as the BOJ is forecast to continue its hiking path to 1.5% by the end of 2027. But why would Japan choose this moment to commit an act that could be considered suicide for the alliance and destabilize the global financial system? The answer is simple and brutal. They have no choice but to prioritize their own survival. The Japanese economy has been trapped in stagnation for too long, and maintaining negative rates to support the dollar decimated the value of the yen, which at one point hit 161 yen to the dollar in 2024, the weakest level since 1986. This devaluation devastated the purchasing power of Japanese citizens, causing import prices for energy and food to skyrocket, fueling inflation the country hadn't seen in decades. Japanese pensioners, who spent a lifetime saving and trusting in stability, helplessly watched their nest eggs evaporate in real terms. The domestic political pressure became unbearable, forcing the Japanese government to act to save its currency and its people, even if the price was the stability of the US bond market. This is a bitter lesson in geopolitics. When backed into a corner, any nation will choose its core interests over loyalty to an ally, and Japan has just proven it will no longer sacrifice its economy so that America can continue borrowing cheaply. The danger stops not just at private capital fleeing the US, but extends to the direct actions of the Japanese government in the bond market. In the third quarter of 2024 alone, Japanese investors sold a record-breaking $61.9 billion in US Treasury securities, the largest sell-off ever recorded from Japan. This trend continued into early 2025, with data from JP Morgan showing that from the start of the year through April, Japan sold a net $227 billion in US government bonds, specifically targeting long-term maturities. Although US Treasury officials and mainstream economists try to reassure the public that $200 billion is a drop in the bucket compared to the market's massive size, they are willfully ignoring market psychology and momentum. When the world's largest creditor begins aggressively dumping your assets, other investors do not sit idly by. They begin to question solvency and the risk of holding US debt. The inevitable result is that they demand higher yields to compensate for the increased risk, which is exactly what we saw when yields on the 10-year US Treasury spiked to 4.92% in April 2025, the largest weekly increase since 2001. As government bond yields rise, they drag the borrowing costs of the entire U.S. economy up with them. From home mortgage rates and auto loans to corporate capital costs, creating a massive drag on economic growth. The Federal Reserve is now caught in an inescapable trap. If they cut rates to save a weakening economy, the dollar will devalue catastrophically, accelerating foreign capital flight. But if they keep rates high to defend the dollar, they will strangle the economy and push the government toward default, as interest payments on the $35 trillion national debt become unsustainable. And this is only half the story. The first jaw of the pincer coming from Tokyo. The second jaw, far more dangerous and strategic, is closing in from Beijing. While Japan sells U.S. bonds out of economic necessity, China is doing so as part of a long-term strategy to de-dollarize and establish a new financial order. China and the BRICS nations are quietly but aggressively building alternative payment systems to bypass the US-controlled SWIFT network, while simultaneously accumulating gold at a record pace. In 2024 alone, global central banks, led by China, bought 1,045 tons of gold, marking the third consecutive year that net purchases exceeded 1,000 tons. Gold, the oldest reserve asset, is returning to center stage as trust in fiat currencies like the US dollar wavers. China is sending a clear message. They no longer trust the safety of US Treasury bonds, especially after witnessing the US weaponize the dollar to sanction Russia. Instead of recycling their trade surplus into US debt as they did in the past, they are pivoting to hard assets and promoting the use of the yuan in international trade. Currently, over 90% of bilateral trade between Russia and China is conducted in rubles and yuan, while India has signed agreements to trade in local currencies with the UAE, Indonesia, and numerous other nations. More alarmingly, Saudi Arabia, the pillar of the Petrodollar system, oil priced in dollars, is openly discussing selling oil in other currencies such as the yuan, euro, and yen, a move that directly threatens the dollar's dominance in global energy markets. The dollar's share of global foreign exchange reserves has fallen from 85% in the 1970s to just 58% today, and this decline is accelerating exponentially as nations realize the US is no longer an absolute safe haven. The convergence of these three massive forces simultaneously, the Bank of Japan hiking rates and unwinding the carry trade, Japan and China dumping US Treasuries, and the BRICS de-dollarization movement, is creating a perfect storm that America has never faced before. The Bretton Woods II system, also known as the Petrodollar system, was built on three main pillars: oil priced in dollars, allies like Japan willing to finance US deficits by buying debt, and abundant liquidity from the yen carry trade flooding US markets. Today, all three pillars are shaking violently. When the final pillar collapses, the entire debt-based economic structure of the United States will face a brutal repricing. What does this mean for your future and the global economy in 2026? We will witness a period of extreme volatility where traditional investment rules no longer apply. As Japan continues to normalize monetary policy and cheap capital recedes, US asset markets will face persistent downward pressure, while borrowing costs will remain high for an extended period. This will expose the structural weaknesses of the US economy, cracks that have been artfully concealed by easy foreign money for decades. The event on December 19, 2025, is not just a monetary policy meeting. It is the bell tolling for the end of an era and the beginning of a new, more multipolar world order. where the dollar is no longer king. Faced with this reality, preparation, both intellectual and psychological, is the most important weapon, because only when the tide goes out do we discover who has been swimming naked, and this time, it appears the American economy itself is at risk of being exposed. If you found this information valuable and want to continue receiving in-depth analyses of global capital shifts that the mainstream media will never tell you, remember to hit like, share this video with those who need to hear it, and leave a comment with your thoughts. Can the US escape this pincer attack? See you in the next analysis.